10-year U.S. Treasury notes yield this morning just hit a 15-year high, which threatens so many. I mean, this is like the benchmark for the whole economy. Steeper costs for borrowers. It's going to send mortgage rates maybe to 7.5% within a day or so. Banks, it's shocking they're not down more pre-market. Anyway, a lot of concern on Wall Street about the potential fallout across all of these industries, stocks, bonds, housing markets. Joining us now is Matt Hornbach. He's Morgan Stanley's global head of macro strategy. Matt, it's good to see you. Do you think that everyone's too sanguine about this? I mean, it's odd how complacent a reaction we're seeing.
Yeah, well, thanks very much for having me on the program. Look, I think we are in a summer lull, a period of time. We are seeing governments continue to issue securities as they do month to month, week to week, and the buyers are on vacation. I think that's the easiest explanation for what we're seeing happening in the market today. There is a lot of bond supply coming to market, and once we make our way past Labor Day, corporates are going to be issuing more and more. So there's going to be a lot of supply for investors to take down. The good news is people tend to go back to work after Labor Day, so we should see more demand at that point. I don't
know. Maybe you're right. Maybe you're right, and this is just a little bit of a quirk. But I feel like, these technical traders always talk about, moves that are – when you start talking about now we're at around 4.3 on the 10-year, 4.42 on the 30-year. I mean, you don't think these hold larger significance that we're able to trade up here and it took us, 15 years to get to this point?
Well, I mean, it's certainly notable that yields have risen this much, but it's also understandable given what we've just come through. I mean, we're dealing with still elevated inflation relative to the past 15, 20 years. And central banks have responded by tightening monetary policy pretty aggressively. And that's one of the things that, came through in the minutes that from the FOMC yesterday is they still think inflation's too high. So it's not totally surprising that interest rates are higher than we're used to seeing.
Right. Don't you? Now he seems to me like like everything's totally fine. So the economy, 4.3% rates, 7.5% mortgage rate, and it's no big deal. This is just the new normal. There's not going to be any kind of shoe to drop or anything.
Matt, is there a number where the duration risk rears its ugly? Is anyone not prepared with their what they're holding? They're marking it at maturity, so they're fine. But is there anyone where, we need to start worrying again about some smaller banks?
Well, Joe, I mean, the time to worry was really last year when the prices of bonds were falling precipitously. And I do think investors took it on the chin last year, pretty hard, in fact. And so, but at this point, with yields higher than significantly higher than they were last year, I mean, the duration risk in the market is actually a little bit lower today than it was a year ago because yields are higher. I mean, that's some funky bond math that I won't get into, but effectively, the bond market, of course, is risky. There's duration risk, similar in the equity market. There's a lot of duration risk in these asset classes. But with the fact that yields are higher does, I think, offer some cushion for investors looking to put money to work in the bond market today.
It certainly does. All right, so let me kind of back up for a second, Matt. Where do you think then, if some of this is exacerbated by thin summer trading or whatever, you fast forward to December, what does the world look like? And where do you think the best investment opportunities are right now?
Yeah, well, I mean, we think the Fed is done hiking. That's a call from our chief U.S. economist, Ellen Zentner. We think they're done. And so we think that they can really focus on the level of real monetary policy restriction in the economy, which should be going up. In other words, policy should become more restrictive as inflation comes down. And we do think that inflation will continue to fall into the end of the year. Our forecasts for core PCE inflation, which is the metric the Fed really focuses on, is much lower than what the Fed has. So
right, but do you think, I mean, they're saying they need to cut rates if that's going to happen because they don't want necessarily to keep tightening, but maybe they do.
Well, at some point next year, yes, we do think they will be cutting rates. And so the investment opportunity, to your question, is really about putting money to work in the sectors of the bond market that are going to react most to those rate cuts. And we think that's the intermediate sector of the yield curve at this point, right around the 5-year maturity point.
It's a good system at Morgan. So if this blows up, it's Ellen's fault. What did Ellen say? She said I mean, it's good to be able to do that. So how do you feel about Ellen's call? What did you say Ellen's call was? That we're not going to, what was that?
That we're done hiking rates. The Fed is done hiking rates.
So if they hike rates, you'll be like, hey, What am I supposed? Ellen, I don't make all these. It's good to be able to spread it around, like diversify the risk at Morgan. So you really think that?
Well, Joe, we have a very collaborative culture, and of course there are certain things that we have a different perspective on. But I think in this case we're very much aligned. I think that
agree.
the Fed is done hiking rates. Yeah.
Really? But that does.
But are they higher for longer?
But
I feel like that's
that
the
could
new,
happen, and the economy's so strong that maybe we're all were you around for 8% and 9%? That used to be normal on interest rates on the 10-year. Remember that? It never going back there, I guess.
Yeah, well, I was born in '76, so my first memory was Star Wars. But we'll leave that for another conversation, I think.
When I hit